By 2026, most stock market advice won't just be bad. It will be confidently wrong, not because people got dumber. Not because markets stopped working, but because the game quietly changed, and most advice is still playing by old rules. If you've ever opened a finance video, a newsletter, or a top stocks thread, and felt like everyone sounded sure, yet nothing seemed to work the way it was supposed to, this is why. Let's start with the uncomfortable truth. The stock market doesn't reward being informed anymore. It rewards being positioned correctly before everyone else. And most advice arrives after that moment is already gone. This matters now because 2026 is shaping up to be the year when that gap becomes impossible to ignore. For decades, stock market advice followed a simple logic. Find good companies, understand the story, buy before Wall Street notices, hold while value is realized. That logic worked because information moved slowly. Earnings reports took time to digest. Economic data trickled out. Narratives formed over months, sometimes years. Advice had room to breathe. Today that oxygen is gone. By the time advice reaches you, the market has already reacted. Not emotionally, not thoughtfully, but mechanically. And that breaks almost every traditional framework people still use to explain markets. Here's where the problem begins. Most stock market advice is built on explanation, not causation. It tells you why something happened, not what forced it to happen. That distinction didn't matter much when humans dominated trading. It matters a lot now. Because markets in 2026 are no longer driven primarily by opinions. They're driven by systems, algorithms, funds that rebalance automatically, risk models that adjust exposure regardless of belief. When a stock moves today, it's often not because someone changed their mind about the company. It's because a rule was triggered. And advice almost never talks about rules. Think about how most advice sounds. This stock is undervalued. This sector is about to break out. The market is pricing in a recession. These statements assume a thinking audience on the other side, but the largest players in the market aren't thinking. They're executing. If volatility rises above a threshold, exposure is cut. If correlations tighten, assets are sold together. If momentum breaks, positions unwind. No narrative required. Which leads to the first reason most advice will be wrong in 2026. It assumes price follows logic. In reality, price follows flows. Money moves because it has to, not because it wants to. Pension funds rebalance. ETFs rebalance. Risk parity funds rebalance. Volatility targeting funds rebalance. None of them care about your thesis. They care about maintaining constraints. This is why markets can fall even when nothing is wrong, and why they can rally on news that makes no sense. Advice that ignores flows is advice that explains the past, not the future. Now layer in speed. By 2026, reaction time in markets is measured in seconds, sometimes milliseconds. Advice is measured in days. By the time a thesis is written, edited, published, shared, and discussed, the trade has already happened, not because the idea was bad, but because it was obvious. Markets don't reward obvious ideas anymore. They punish them. This creates a cruel irony. The more persuasive and well-argued the advice sounds, the more likely it is that the opportunity is already gone. Because clarity usually comes after the move. Which brings us to the second reason most advice will fail. It confuses explanation with edge. Explaining why a stock went up does not mean you could have predicted it. Yet most advice is packaged as if it could. Here's why this rallied. Here's what the market is thinking. Here's what happens next. The market is not thinking, it's responding. And responses don't require foresight, just triggers. This leads to advice that feels smart but performs poorly. It's always just late enough to sound reasonable, never early enough to matter. Now let's talk about forecasts. Because 2026 will expose how fragile they really are. Forecasts assume stability. They assume relationships between variables will hold. Rates affect stocks in predictable ways. Inflation affects valuations consistently. Economic data leads price movements. But markets today are reflexive. They react to expectations of reactions. A strong jobs report can be bullish or bearish, depending on how it changes rate expectations, depending on how those expectations affect positioning, depending on how crowded that positioning already is. Advice that says, good news is good or bad news is bad, collapses under this complexity. By 2026, even professional forecasts, will increasingly fail not because the data is wrong, but because positioning overwhelms fundamentals. This is why markets can move violently in the wrong direction for weeks. Advice keeps insisting reality will assert itself. But the market doesn't operate on reality, it operates on leverage. Which leads to the third failure point. Most advice ignores leverage entirely. Leverage is invisible when things are calm, but it dominates outcomes when they're not. A small move becomes a forced unwind, a modest shock becomes a cascade. And advice that says, this drop is irrational, misunderstands the mechanism. Forced selling is not irrational, it's contractual. By 2026, leverage will matter more than opinions. And advice that doesn't account for it will misread risk every time. Now let's address the elephant in the room. AI. By 2026, a massive portion of market activity will be influenced, directly or indirectly, by models trained on past data. These systems don't seek truth. They seek patterns that worked before. This makes markets more efficient in calm periods and more fragile during transitions. Most advice assumes markets adapt smoothly. AI doesn't adapt. It extrapolates. When conditions change in ways not represented in the data, models don't get cautious. They get confused. Advice that says, this time is just like last time, will sound comforting. It will also be dangerous. Because regime shifts don't announce themselves. They only become obvious after advice has failed. Now zoom out. Why does bad advice persist? Because it's emotionally useful. It gives certainty in uncertain systems. It provides stories where there are only probabilities. It makes chaos feel interpretable. But markets don't owe us clarity. And 2026 will be especially unforgiving to anyone who expects it. Here's the final uncomfortable layer. Most advice assumes you are competing against other humans. You're not. You're competing against structures, against mandates, against rules, against automated responses that don't care if you're right eventually. Advice that says, just be patient, without explaining what you're waiting for is incomplete. Advice that says, buy quality without addressing timing is evasive. Advice that says, ignore the noise ignores the fact that noise now moves prices. So what does good advice even look like in 2026? It's quieter, less certain, more focused on risk than reward. It talks about what could break, not just what could work. It acknowledges that sometimes the smartest move is doing nothing, not because you're confident, but because the odds aren't favorable, and that's the hardest advice to sell. Which brings us to the final question. If most stock market advice will be wrong in 2026, not because people are malicious, not because they're incompetent, but because the system has outgrown the way we explain it, then what does it even mean to be well-informed anymore? And if everyone has access to the same information, what actually separates those who survive from those who don't?